Lountzis, and I'm here in the thought leadership session discussing Wide-Moat investing. I wanted to share with you some of my thoughts on a few specific examples of successful investment ideas, as well as a couple that failed, and areas where I understood the moats and analyzed them correctly, and other areas where I didn't. I wanted to start with, on the positive note, one of our successful investments, which was Abbott Laboratories. That goes back over a decade. Abbott Laboratories, back in the 2000-2001 timeframe, was a diversified healthcare company. They were generating revenues in the area of $13 billion through 5 different segments: U.S. pharmaceuticals, diagnostics, nutritionals, hospital products, and international operations. Each of those segments did over $2 billion in revenue, with the international segment, primarily the pharma, doing over $3 billion. And so collectively it was about $13 billion. We evaluated each of the segments. Ross Nutritionals out of Ohio, which had both pediatric and adult nutritionals, the hospital products business, injectables, etc., which was later spun out and is now Hospira, a separate company. The diagnostics business, where they were one of the leaders in selling diagnostic instruments to hospitals, particularly in immunoassay and molecular diagnostics. And then their pharmaceutical business domestically, where Abbott was historically a stepchild in the pharmaceutical business. They had come out with erythromycin many years ago, and then Viaxin, which was licensed in. They were never really successful in the pharmaceutical space. And so in evaluating the business, the stock was selling in the mid-20s and at a very low multiple of historical earnings. They had tremendous diversity in revenues. About 65% of the revenues were domestic, the rest were abroad. And they also had tremendous diversity in their business segments. Diagnostics, dating back into the 70s, when it was led by Jim Vincent and Jack Schuler and Kirk Rabb, all terrific people, many of whom left, including Gordon Rathman, who left to start Amgen. They had a leadership position in diagnostics, which was a recurring revenue business model, and they had a very strong, what I would call a mini moat in that space. So we felt very comfortable about that business, and we valued it accordingly. The hospital products business, while they had some commodity components in that area, they also had some unique proprietary products in injectables and other areas, and we valued that business as well as a standalone. The nutritionals business, the infant formula Similac, and the adult nutritionals that we felt had a long runway to grow both domestically and abroad, also was a leader with very, very few competitors. And then finally, their international business, where they sold a multitude of products. They were growing and building in their international business. In thinking about Abbott, we valued each of the segments, and we ascribed a zero value to their $2.5 billion in pharmaceutical sales. And we still came up with a value 25 to 50% higher than the current stock market price. And we felt that their pharmaceutical business was an option or a warrant that we were paying nothing for. Ironically, in the year 2000, they purchased Nobel Pharmaceuticals for $6.9 billion, which had a unique joint venture in it. It was owned by BASF, the huge German chemical company, and BASF Research Center and Cambridge Antibody were working together on a drug called D2E7. While we knew about it, we certainly didn't have any capability to understand its ramifications. We just felt the Abbott pipeline was interesting, and we were paying nothing for it. Ironically and fortuitously, in 2003, they launched what became known as Humira, that D2E7 drug, and the warrant paid off very, very handsomely. Today, Humira is one of the top-selling drugs in the world, and in terms of looking at this investment, we evaluated the moats in each of their other segments, felt we had a predictable, stable, diverse business, both product-wise and geographically, and we were very fortunate in that they had a very, very successful drug come about for which we paid nothing. And as a result, the stock price tripled over it. Plus, you received some attractive dividends during that time. So it's the kind of investment that we look for, low risk, with optionality to it. And in this particular case, we were fortunate and successful. A second example is a much smaller company with a little bit of a different moat that was partially created by their patents and their unique technology, but even more created by the uniqueness of the market in which they were operating. It's a company called Arrow International, based in Reading, Pennsylvania. I was introduced to it in the early 90s when they came public, and it was led by Marlin Miller, a true visionary and an extraordinary leader. Marlin grew up in the Midwest, was educated at Harvard Business School, and was just a first-rate business person on every count, analytically, integrity-wise, etc. The company sold medical devices, and it was dominated by two major categories. The first was central venous access catheters, which in 2006, August of 2006, did $250 million in revenue, and specialty catheters that did about $150 million. So $400 million of their $480 or so million in total revenue was these two areas. They had some unique technology, the Arrow House catheter, the Arrow Guard, and so forth, and some others. They had these catheters lined with antibiotics and other things to prevent infection, and they were much higher priced than the traditional, cheaper catheters. They also had multi-lumen catheters and so forth. The important point here was that even though in many cases, the prices of their products had very limited pricing power, and in some cases, some of their products, the price of their product declined annually, because of their significant market share on a global basis within central venous access catheters, which was maybe a $500 million global market, and they might have had 50% of that market. And in the specialty catheter space, another equally sized market, they probably had about a third of that market. The marketplace itself enabled them to face limited competition long term because of the overall sizes of their markets, the markets they were participating in, and the size of the competitors with whom they were competing. Outside of Cook Medical, a private company in Indianapolis, many of their competitors, or companies that could be competitors, such as Johnson & Johnson, C.R. Bard, and Medtronic, and others, were simply uninterested in entering that area because the market size was simply not big enough, and their penetration of that market was so large. They would rather have just purchased Arrow International to enter that market and then run it through their own existing sales force by cutting costs through removing or eliminating a large portion of R&D and sales. And interestingly, it took me a long time to gain a comfort level with Arrow. However, 8 or 9 years after I met Marlin, in the late 90s, the stock was selling for 9 times earnings, whereas most other medical device companies were selling for double that. They were viewed as too small. They only had a $25 million R&D budget, very small and dwarfed relative to Medtronic, C.R. Bard, and others. However, they had a unique niche, and in speaking to Marlin Miller, where a lot of insights came, and he helped me better understand what their real moat was, that many of their competitors, C.R. Bard, Johnson & Johnson, Abbott Laboratories, and others, were frequently calling him because they were interested in his product lines and in his business. So from that perspective, I felt that Arrow was something that I should delve into. I met with Phil Fleck, their head of R&D. I assessed and evaluated their products. I evaluated and visited with their competitors and their competitors, spoke to many of their customers to gain an understanding of the industry, the market size, and what was unique about them. In doing so, we made the purchase of Arrow in the $17, $18 range and held it for 6-7 years until it was acquired by Teleflex in early 2007 for $45.50 per share. I might also add the company had zero long-term debt, was very conservative in every way, and it illustrates how moats are not always created by the company, but sometimes can be created by the industry in which they compete and the market in which they compete. They did have some unique patents and some unique technology, but that wasn't the real moat in this case. The real moat was their leadership position in a market that simply wasn't that large, and it would not have behooved their much larger competitors to try to enter that market on their own. A third example is Beckman Coulter. It was a leading supplier of instrumentation to hospitals with leadership positions in chemistry, where they had large chemistry instruments, where they had a 27% global market share. The second area was hematology, where they had a 50% global market share. And the third was immunoassay and molecular diagnostics, where they had maybe an 8 to 10% market share, but it was the most rapidly growing. Beckman Coulter was a $3.6 billion hospital instrumentation company. 82% of the revenue was recurring, and 18% was based on instrument sales. They had 4 different segments, which I briefly discussed. The first was clinical chemistry and automation, generated about $1.3 billion in sales back in 2010, 2011. The second was hematology, which generated just under $1 billion in revenue. And the third was immunoassay and molecular diagnostics that generated just under $900 million. The final one being their life sciences business, which was kind of a stepchild, generating just under $500 million in business. Combining all those, as well as their Olympus purchase, which strengthened their global opportunities in chemistry, they were generating $3.6 billion in revenue, over half of which was abroad. In assessing and evaluating the moat, what was interesting was they had leadership positions in 2 major areas, clinical chemistry and hematology. And secondly, their immunoassay and molecular diagnostics business was coming out with a new product that would give them even more thrust in that business, which was the most rapidly growing and the most profitable. Furthermore, they were generating $500 million in sales, 15% or so of revenue in Asia, $300 million of which was in China. And those sales were growing at 20% per annum. So the moat they had several moats. First, unique proprietary technology in hematology and in clinical chemistry and immunoassay, combined with 5-year contracts with the hospitals. So you had guaranteed 5-year revenue streams. Sizable switching costs for companies to switch, although not enormous, and recurring revenues. Once you place an instrument, you make enormous amounts of money on a gross margin and operating margin perspective on the reagents or reusable reagents. All those factors gave me the conviction, as well as speaking with competitors and former employees and customers, gave me the conviction when a wonderful opportunity came about in the summer of 2010. They missed their second quarter earnings in June, at the end of June of 2010, and they lowered their earnings forecast from $4.40 to $3.90. The stock price declined from 62 to 44. We had been buying it in the low 50s and were owners as it rose to 62. The reason for the earnings shortfall was they had a product called that measured troponin, which was a heart enzyme that they measured, and they were going to have to withdraw that from the market and spend a great deal more money to get that approved through the FDA. And two of their other divisions, life sciences and hematology, did not meet their earnings targets. As a result, when the stock price declined from 62 to 44, we took a closer look and reassessed the sustainability and strength of their moat, the moats that I described earlier. We became convinced that the company was secure. It had a strong balance sheet, was generating significant free cash flow, had about $1.3 billion in debt, but over the next couple of years could pay it down to almost zero because of the cash flow, free cash they were generating. And we bought more shares of Beckman Coulter. We also felt that because it was the lone single player in that space, it was an attractive acquisition candidate. Many of its competitors, virtually all of its competitors, Roche, Abbott Laboratories, Johnson & Johnson, Siemens, that were competitors, all were owned by large conglomerates. As a result, we were fortunate. In December of 2010, rumors began swirling about Beckman going up for sale, as after the second quarter earnings, their CEO, Scott Garrett, resigned. And we didn't think it was a permanent structural problem, just a cyclical problem. Fortunately, we were right, and Danaher stepped up to the plate and purchased Beckman Coulter for $83.50, providing another attractive holding for us. While we could not have predicted that they were going to be acquired at almost double the low achieved in July of 2010 of $44, what we did know was it was an attractive and valuable company with unique moats and strengths that we felt others would find value in, and we were confident those revenues and earnings were simply not going to go away. It was simply a short-term cyclical challenge they were facing. Two mistakes of commission. I don't want to go into detail on all of them because there have been so many, but two that come to mind were Harsco, which was an industrial company based in Harrisburg, PA, operating through 4 business segments and generating, back in 2008, almost $4 billion in revenue. The 4 businesses were infrastructure, where they did concrete forming and scaffolding around the world for companies, which generated $1.4 billion in revenues. Their metals and minerals business, which also generated just under that $1.3 billion, as they provided in-house outsourcing capability for a lot of steel mills around the world. Their rails business, which was their third segment, generating about $400 million to $450 million in revenue. And then finally, their diverse industrials business, which had 3 or 4 other companies, and they're also generating $400 or $500 million. What attracted me, and where I thought the moats were interesting, is 80% of their business was service-based as opposed to manufacturing. Several of their businesses had recurring revenues. They had a global platform for their businesses, and they were leaders in many of the markets in which they served. Additionally, they had a clean balance sheet and were growing around the world as the global economies were growing. One of the mistakes I made was I noticed the large capital expenditures they had made in 06 and 07. And many of those capital expenditures were invested in their infrastructure business, which disappointingly was 57% based in Europe. Our feeling was that because they're one of the few companies in the world, as the infrastructure business with scaffolding and concrete forming is typically a local business, our feeling was they're one of the few companies in the world that can go around their world and move their products and services all over the world, as opposed to many companies who can't because it's local based. Unfortunately, the global economy slowed, and their ability to move from Europe to Saudi Arabia and work with Bechtel for refineries in other parts of the world was simply not possible, given the declining global economy. As a result, their infrastructure business revenues declined over the next 4 years from 1.4 billion to just over 900 million. And sadly, the company simply, even though the other businesses were all doing extremely well, they were simply unable to overcome that challenge. Another important point during our analysis was the CEO, Sal Fazzolari, was instituting economic value added, or EVA. They were very financially astute from that perspective, and he was consolidating everything under the Harsco brand. For example, in Europe, they had several operations under different names, one in the UK, one in Germany, running under Hunebeck and others, that were building their infrastructure business. They consolidated all those under one Harsco name and moved the headquarters of their infrastructure business from London to Harrisburg. So there were many things that we liked about the business. They had solid and strong competitive advantages, we thought, in each of those areas. And it proved to be accurate in their metals and minerals business, their rail business, and their industrial businesses. Unfortunately, we did not accurately assess their ability to move their infrastructure operations around the world, and certainly they were impacted by enormous headwinds with the global economy slowing and people not requiring the need for those infrastructure services. As a result, we had bought the stock from the low 20s to the low 30s. And after a few years, we ended up selling it in the low to mid 20s, resulting in a loss for some of our clients and about even for some of our others. While they also paid a dividend, it was clearly a mistake. And we didn't adequately evaluate the strength and the moats in their infrastructure business. And finally, another mistake dating back into the late 90s and early 2000s was Mattel. Mattel had made Jill Barad the CEO, and she had been very successful building the Barbie brand to well over $1 billion in global revenue as an outstanding product manager and then leader of that group. However, when one becomes a CEO, not only do they need to be great operationally, they need to be very strong on the capital allocation side. And those are two areas that we really focus on with companies. First, their ability to maximize the operating capabilities of the business as great operators, and secondarily, to wisely and prudently allocate that capital. There's very few CEOs that are good at both. At the time, 1999-2000, Mattel was a $4.5 billion enterprise. Tremendous brands. The Barbie brand, Fisher-Price toys, Hot Wheels, and many other outstanding brands that appealed to children around the world. Jill Barad, at that time, had never really been in a CEO position and had been focused almost exclusively on Barbie. We felt that their brands, their global reach, and the power of their consumer products within the infant and children's categories were significant competitive moats. Many of these brands had been around for decades, and kids always enjoyed playing with them. However, what we didn't anticipate was a capital allocation decision that Jill Barad made. She purchased the Learning Company, which had $800 million or so in revenue, paying over 4.5 times revenue, or $3.5 billion, to acquire it. And when the challenges arose and became evident, I believe it was the third quarter of 1999 or 2000, when the learning company was supposed to earn 50 million and they lost over 100 million. And their losses continued to grow, ending that year, I believe it was 1999, with over $282 million in losses. Here was an example of, while the company had outstanding brands and strong moats through those brands, excellent global distribution, tied in with, as Mr. Buffett calls it, the share of mind with children. They love Hot Wheels and Matchbox and Barbie. These are iconic brands and powerful brands. What we didn't anticipate was her purchase of a company for which they had very little knowledge and for which they grossly overpaid. Ironically, Bob Eckert came in several years later, who was an outstanding capital allocator, having come from the craft operations within Philip Morris in Chicago, and ended up selling the business to the Gore brothers, the learning company, for virtually nothing. And so the point being, while we assess the moats of the products and the businesses they were operating, we did not adequately anticipate nor understand the importance of capital allocation and how this misallocation fundamentally impacted Mattel in such a terrible way. The stock had risen to as high as 40 in 1998 and subsequently declined to as low as $9 after the challenges at the learning company. We had purchased the stock in the low 20s after it had declined from 45 to 21, 22, 23. However, we did not, again, anticipate the challenges on the capital allocation side with the learning company. They didn't do their homework. They didn't understand what they were buying. They didn't understand the lack of systems, and their products lacked loyalty, even though they had Reader Rabbit and some others. We just didn't realize all those things. And as a result, we hung in there. We didn't have the courage or conviction to step up and buy more of it at 9, 10, or 11, unfortunately. And after holding it for a few years, we ended up selling it right around cost to a little above cost. But in terms of opportunity cost to our clients, it was clearly an unsuccessful investment. And so those are a few examples of investments that we've made that were successful, and a couple that we've made that were unsuccessful. And I hope I've been able to give you some of my thinking as to why we succeeded and why we failed.